Self-insure for tax-free living benefits. In this episode, we're going to address the question, why would I want to pay the most premium into an IUL policy? This is episode 14 out of 21 in a series called Secrets to a Tax-Free Retirement. And I would advise that you invest a few hours and view the entire series to empower you to be able to accumulate an extra $1 million. Why? Because that $1 million can generate an extra $100,000 a year of tax-free income for as long as you retire. This is a free course. So at the end of this episode, I'm going to show you how you can claim your free copy of my most recent best-selling book. It's a 300-page book titled The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. It's actually two books in one. One is for left brain learners, and it is comprised of about 200 pages, 14 chapters with all kinds of charts and graphs. And in that book, in chapter 13, you will learn how to self-insure, the self-assurance of being self-insured, which I'm going to talk about in a little bit of detail in this episode. You flip the book over, and there's about 100 pages with 12 chapters with 62 actual client stories explaining how a max-funded indexed universal life insurance policy can be used not only for retirement, probably the most popular use of the contract, but also for a business, working capital, for college funding, for real estate equity management, for lump sums, for emergency funds, and on and on and on. But let me explain the concept that I touched on in previous episodes at the beginning of this series, so that now that you've had some understanding, if you've been watching these in sequence, of how this came about and how it works. So way back again, when E.F. Hutton came up with the idea of taking the least amount of insurance the IRS will let you get away with and putting in the most premium. A lot of people said, well, why would you want to do that? It's because up until 1980, most people took out life insurance for death benefit. In other words, what's the least amount of premium? What's the cheapest premium I can pay to get the amount of insurance I need? 2 or 3 million or 5 million or whatever, because you want to have the least expensive insurance in order to pay off the greatest amount when you die. E.F. Hutton said, whoa, let's flip those objectives. Let's use it for living benefits, tax-free accumulation, because it is a sacred cow in the Internal Revenue Code sections 72E, 7702, and 101A, as explained in previous episodes. And as long as you comply with the tax citations TEFRA, DEFRA, and TAMRA, this turns into a tax-free sacred cash cow. Now, people always say, well, why would you want to pay the most premium? Because your objective is for living benefits. You want the highest internal rate of return, so that you might earn a gross of an average of 11%, you want a net 10%. If you earn 16, you want a net 15. If you earn 8, you want a net 7. You want only one of those percentage points to sort of go out in the spigot on the bucket. When you see an illustration of an insurance contract, I often show a bucket, and there's a spigot at the bottom. And that drains out a small cost, the cost of the insurance that the IRS says has to be there, or it moves from the tax-free sections of the code under insurance over to the taxable portion of the code, investments, that are also subject to market volatility and taxes sooner or later. You want to stay grandfathered and protected under the tax-free portion. So you must have a commensurate amount of insurance coming along for the ride. That was dictated under the Tax Equity Fiscal Responsibility Act of 1982 and the Deficit Reduction Act of 1984. But the concept really started with self-insurance. So in a previous episode, I talked about how if you wanted to set aside, let's say, $500,000. Back in 1980, people could put $500,000 into an insurance policy and the death benefit was basically $500,000. Well, people say, well, who pays $500,000 for $500,000 of life insurance? If you're using it for tax-free living benefits so that $500,000 generates at 10%, 50 grand a year of tax-free income instantly, which many people experienced, that is when you want to have the least amount of insurance. And that's when the IRS said, what are you doing? I think you're overstepping your bounds. And they went to court and E.F. Hutton won and they went back and that's when TEFRA and DEFRA was passed. That's when they said you have to have a commensurate amount of insurance. There's got to be some risk. And if you put $500,000 into an insurance policy that has a death benefit of $500,000, there is no risk. The insurance company's not at risk. So how do they make their money? By investing your money. So when they invest your money, they make money investing the money. But if they don't have any risk, then golly, they can invest your money and the cost they charge you for the amount at risk goes down as you get older. And that's why I explained in previous episodes, the cost of the insurance can get cheaper as you get older. So how does this all play into, well, okay, how much am I charged for the amount at risk? So this may be a bit of a review if you've watched previous episodes, but let's say for a 60-year-old, after TEFRA and DEFRA tax citations were passed, the minimum amount of insurance at risk to the insurance company that was required if you wanted to put in $500,000 was about $1,250,000. But hello? If the insurance required to qualify for tax-free accumulation and tax-free access was $1,250,000 for that 60-year-old. For a younger person, it was more insurance. For an older person, less insurance, because the cost of the insurance is the same no matter how young or how old or how unhealthy you are, because the amount of insurance can be squeezed down. It's called squeezing down the death benefit, so that if your objective is internal rate of return within 1% of the gross rate of return, if you're going to average 11 and net 10 like I have, you want only 1% coming out to pay for the cost of the insurance that the IRS says has to be there or it won't be tax-free, whether you're 80, whether you're 60, whether you're 20, okay? And so at age 60, it would be $1,250,000 for an insurance contract where you put in $500,000 in what is called the guideline single premium. You don't have to put that in all at once, but back then you could. So if you put in $500,000 and you die, you could actually opt to have the cash value added on top. Well, that's if you want to maximize what you leave behind. If you want to maximize your internal rate of return, so that if you earn 11, you net 10, instead of earning 11 and only netting 7 or 8, you want to have your cash inside the insurance policy that you put there and the interest you earned on it qualify as part of the death benefit. If I put in $500,000 and the death benefit was $1,250,000 as required under TEFRA and DEFRA, the only amount at risk is the remaining $750,000. Now, my $500,000 growing at 10% is going to be worth how much in 7.2 years? Rule of 72, if it's earning 10%, $500,000 is going to grow to $1 million. Now I have $1 million of the $1,250,000 is my own money. I'm self-insuring. It's my money. The insurance company is only at risk now for $250,000. So even though I'm 7 years older, the cost of the insurance has gone down because I'm only paying for 1/3 the amount of insurance I was paying for 7 years earlier. I was paying for $750,000 at risk. Now I'm only paying for $250,000. If you do the math, $1 million in another 7.2 years at 10% will double to $2 million. Well, wait a minute. I have $2 million of cash inside my insurance policy, and the death benefit was $1,250,000? No problem. TEFRA and DEFRA says now your death benefit will grow with your cash It cannot be the same until you're age 95 or 100, depending upon the contract. It has to stay 5 percentage points ahead. So if I have $2 million of cash value, the insurance is $2,100,000, 5% higher. But the insurance company is only charging you for the $100,000 they're at risk for, because you self-insured the other $2 million. Now, even though you might be another 7.2 years older, you are only paying for $100,000 of insurance now, and you have $2 million earning all this tax-free interest. So you're earning this much interest, and the cost of the insurance is only this now, because the amount of insurance you're paying for has gone down dramatically since you opened the account or started the insurance policy. So what does that mean at the end of the day? So many times I will state an average cost of the insurance over the first 10 or 20 or 30 years of about 1%. In the earlier years, it could approach 2%, but the longer you go, the cheaper the insurance becomes. So if during the first 20 or 30 years of an insurance policy, you were to average a gross return of 11, you would be netting probably at least 10. If you earned in any given year 8, you'd net 7. If you earned 16, you'd net 15. Some years you earn 25, you net 24. So one of those percentage points pays for the cost of the insurance and all of the fees that are associated with the contract. That's the average. But the older you get, the more money you're making on your money as it compounds and grows. Therefore, the amount of insurance that you're paying for is less. Right now, at my age, the insurance that I'm paying for is 1/20th what it was when I was 30 years younger. So if I'm only paying for 1/20th the amount of insurance, even though I'm older, I have so much cash earning interest that just a minuscule portion of that interest is paying for the cost of the insurance. And so if I earned 11% on some of my oldest universal life insurance policies this year, if I earned 11, I would probably net 10.9. The insurance is costing me 1/10 of 1% this year. But average over the life of it, it's usually within 1% of the gross rate of return. You wouldn't believe how many financial advisors and insurance agents do not understand that. Sometimes they go, I've never seen one that has done that. Well, then you haven't seen one that has been structured correctly, because unfortunately the vast majority that I look at are not structured correctly and funded properly. So I implore you to continue to watch the other episodes in this series, Secrets to a Tax-Free Retirement, because it's critical that you structure it correctly, and you can take advantage of self-insuring your future and have the cost or the risk go down, down, down as you get older. So if this episode is intriguing you and you'd like to learn more, be sure and watch this next episode. But if you like to read and learn and watch and learn and listen and learn, I would invite you to claim your free copy of my most recent best-selling book, The Laser Fund. It contains over 300 pages of charts, graphs, explanations, in-depth detail. And when you flip the book over, you can read 62 actual client stories and examples. So to claim your free copy, I'll pay for the book. You go to laserfund.com, page $5.95 shipping and handling, and I'll fire out a copy for you to study and learn, and then you can become empowered to have a brighter future.